What is happening, best ever listeners? This is Matt Faircloth, and welcome to the Next Level CRE show for the Best Ever CRE podcast. Thank you for listening. My segment, Next Level CRE, comes out on Fridays. So mark your calendar on Friday and come see your old buddy Matt talking about all things real estate, all things next level for you, your life, your business. If you guys like what we have to say here, do us a favor and subscribe to this show. Do yourself a favor and subscribe to this show, because that means that you'll get in your feed for your favorite podcast app, you'll get notices of the show. It'll just automatically just show up right there. So you can grow your real estate knowledge alongside us for all things real estate investing. And today's show is something I want you to take a minute and share this show with someone who in your real estate circles is talking about private equity or working with family offices, okay? Because that's what we're going to unpack a lot of that today. And the idea of growing into scale. Our guest owns billions of dollars worth of real estate, billions of dollars worth of real estate. And he did a lot of it with his own money, and God bless him, great success in a prior life before real estate, but then rolled a lot of it and probably 10 or 20x that wealth that he had into real estate through working with family offices, private family offices, and private equity. So forward this to someone that you know, because all y'all know some syndicator friend that's all like, I want to get in front of family offices. I want to get those big checks. Okay, send this episode because we unpack all of that. And if that person is you, then listen up. This is a great show about talking about how to get access from corporate capital, corporate checks into your businesses. And we also, of course, get into my buddy Ian's backstory on how he was able to generate a lot of cash to get it to really kickstart his real estate business. So let's hop into the interview. Best ever listeners, I've got a phenomenal guest for you guys today. This is success all bottled up into a podcast for you guys. We're going to talk about some really interesting stuff in maybe asset diversification, all kinds of cool things. My guest today is Ian Djuric from Blake Capital Group. Ian's a diversified real estate owner. He's got a $2.2 billion in assets under management. That's a B, you heard in there. 7,000 units of multifamily, over 600 units of hotels, 200,000 square foot more than that of industrial real estate, self-storage, car washes, all the things, a partridge in a pear tree in there as well. So we're going to get into some really cool conversations on scaling and that. So Ian, welcome to the Best Ever CRE show today.
Matt, thanks for having me. Excited to be here.
Me too. So you have a backstory here in getting through the waste management industry, the Tony Soprano land, everything like that. What was that like? And how did you build that out? And then all of a sudden drank the Kool-Aid in the back of the room to get yourself in real estate?
It's a fun story. I always say, I'm not a genius. I'm just a hustler that made it. So I started off selling trash service door to door, just knocking it out, banging it out door to door, selling for the local company versus waste management. Got really good at it, and then started my own sales company. Managed 144 kids doing B2B and B2C up and down the East Coast in about 7 different markets.
Selling trash service, like just knocking on the door of the hair salon and saying, hey, I want that. I want to manage that dumpster you got behind your store for you, right?
This was even more like residential door to door, like selling solar, Cutco knives, all that jazz. And then we got into the door to door and business side of it. But it was fun.
You were selling... Were you using that as an analogy, or were you really doing the Cutco thing and all that? What were you doing?
It was a parallel example. People sell Cutco knives door to door or solar door to door. I just sold trash service door to door.
How does again from my just edification standpoint, if I live in a certain area, isn't trash service typically governed by my local municipality? Do people really have a choice on who they
Only
can?
Only 45% of the U.S. is governed by municipality. The other rest of it is you can choose your own. Like some neighborhoods have 5 different trash companies that'll come into the neighborhood and pick you up.
Huh. Okay.
So take Fairfax, Virginia. I went to college, George Mason. Fairfax, Virginia has hundreds of thousands of single family homes that all pick their own hauler, and there's 9 different companies in the county. Yeah, and we worked with one of them versus the big national guy and just went door to door and knocked it out. I think I switched over 1,100 customers in one summer.
Is it typically a price conversation? Like, listen, you're paying...
It's a 30-second price conversation.
You're paying X, I can do it for Y.
Same service, brand new can, 30% less, knock you out in 30 seconds.
Right. It's just, it's a volume play, right? Yeah,
100%.
It's an easy fit. Well, that's how you could scale out a workforce, because at the end of the day, it's like, hey, do you want to save money? Like you said, a brand new can, I can get you all this and get you reliable service for X amount of dollars. You in and you out, right? That's great. So you scaled out that business and then took an exit. What year was that?
God, 8 years ago. So like 2017.
Hmm. What were your big moments that you carried over into real estate from scaling out a business, scaling out this waste management service? What did you bring over into the real estate world when you exited?
Doing it right the first time. We learned that mistake over and over in the trash company because we're growing at such a scale. We just got stuff done. It would always come back to haunt us because like we'd take shortcuts, we'd duct tape stuff, we'd skip stuff over. And then coming to real estate, it's like, let's define the process, have the key metrics that we measure every single day, and let's do it right the first time. Let's hire the correct person. Let's not just hire somebody and have them do the role. Let's overpay, do what we got to do, bring in the right operating partner, bring in the right salesperson. Like we're doing it right from day one. And that's really led us to most of our success. It's just holding that standard. And then winning the right way is probably the second one. And like you can win, but like you don't, like, if you're taking shortcuts, you're cheating, you're messing with your underwriting, whatever you want to do, like win the right way. Especially when taking on like investors. It's how do you present? Don't over project your numbers, be realistic, be super transparent, win that investor over the right way. And then when you perform, when doing that, they're a lifelong investor. And that's really what's led to a lot of our success from institutional family offices and now even into retail of just massive repeat investor databases or investors.
Love that. Again, I said before, there all of a sudden you had this exit, for goodness sakes, why did you decide to jump in this lovely pool of real estate investing? Something must have attracted you to the business. Were you involved in real estate before, or was it a venture after you exited the waste management companies?
I was in real estate before. Like I was making several $1 million a year easily with the trash company and profits. And I was a completely uneducated real estate person. So I was LPing 100K, 250K into anything and everything. No idea what I was looking at. Like, to be honest, I was just more trusting the sponsorship side. And then I had a whole bunch of single family homes and a couple of small multis. And like, that's easy to run because like on an 8-unit multi, you can just evict everybody, renovate real quick and release it up. And like, you're okay. Versus like a 200, 400 unit property, you got debt service. You can't just rip everybody out. You got to slowly run a process to get it done. So small multifamily, like 87 single family homes and a ton of limited partnerships. But I sold the business and I was like, what do I want to do? And I was like, I like real estate. I like syndication. Like I know how to run a 9-figure company and build out a huge, phenomenal team. And I like real estate. So instead of going to like a Brad Sumrock or somebody else's like class or educational thing, I was like, I can't learn from a class. Some people learn phenomenally from coaches and classes, and that's best. But I'm a hands-on guy from the trash side. I'm like, I gotta get my hands dirty. Yeah. So I went to my 2 favorite sponsors, like, hey guys, here's the deal. I'm gonna fully fund your next deal, except I'm gonna run it, and you can babysit. You can keep your fees and your promotes, like make all your money.
So I want to write all the. You roll in. I want to be the equity. You're now transitioning from being the lead sponsor to being my mentor. Right. Mm-hmm. So now you're going to like sit over me and stop me from screwing it up. And that, were you guaranteeing the debt too? Were you willing to step onto the debt and really I signed
on the debt, provided all the equity. I did everything.
Full JV. Okay.
Full JV, everything. They got their fees and their promotes. It was nice. It's fair.
Right. They win too. You're not buying them out. Like they're still partnering with you, right? How big were these deals?
We invested $23 million. They were big.
Yeah. Big. Okay. Right.
They're around $30 to $40 million a piece. So not bad.
Okay.
They're both Fannie Mae deals.
Multifamily?
Both multifamily.
Okay. All right.
It's the best way to learn.
How did that go? Was that successful? I
learned how to over renovate very quickly. So dramatically over renovated very quickly. Learned I was not get the ramp ups I wanted to by doing so. We pivoted, went back out to all my comps, studied and that's one of the things we still learn to this day is like when we go into our comps and we see, cool, they have flooring, countertops, cabinets, sinks, like what are we actually applying to what's the sink worth in an NOI boost or rent bump? Like what are we accumulating? Is that a $35 piece? Are appliances $75? Like what are we really getting from each? So we come back to our units. We're like, cool, if I can really get away with we have a deal in Houston and we had a full $8,000 rental package to get us to about $175. We end up just being able to do stainless steel appliance packages and a sink for $120. So we scrapped the whole package and that cost me less than $1,000 for that and you're getting $115, like that's the best deal ever. You're paid off in less than a year and screw the rest of it.
There's so much in the economy of scale in real estate, and that, like, people are like, why are you worrying about, there was one time we were doing a deal and the outlets that our property manager wanted us to put into the units were like, it's something stupid, and it was like $40 an outlet installed or whatever. And I'm like, why the frick do I need a $40 outlet? Well, it's there's a nicer finish and it's look. And I'm like, no, F you. You're going to put on the $20, $15, whatever it is, because do the math, times 200 units, times how many outlets are in that apartment, right? All these things scale in multifamily. And it's like, it's why you get granular on like, how much is a like a cabinet pull knob going to cost me? How much does it cost to turn that kitchen? How much are we paying for appliances again? Because if I can save $50, then whatever that is, $50 times the units, times the amount of times you can do it over and over and over again, right? So you learned the economy of like micro costing times scale equals big savings, right?
100%.
Got it. So we're there. Did you stay in the multifamily world for a while in that space, or did you transition out?
So we did a ton of institutional investment. We grew immensely, like Tides or Rise did. Like we grew quick and fast through institutional equity. So like Citizens Bank, Equity, Multiple, Yield Street, all the big guys loved our background, loved what we did, and we just brought in the mass volume and did it. But we didn't want to be a big multifamily player. We wanted to offer investors something more niche, unique. Like multifamily is fun, but like it's overplayed in my opinion. Everyone's invested in multifamily. It's great, but like our investors like, give us more, give us things that you want. So we started to diversify, and we went into industrial, and then so like we played, like it takes 8 years to get into all these categories. But we've brought in some of the most phenomenal operating partners. Like for example, like we're in car washes right now, and we brought in the most phenomenal operating partner. Like I think I'm a smart guy. We have a great team. I built up a $100 million company and sold it. And now we're in real estate. But we went and found a wonderful gentleman. His name is Keith Lawrence, and he built up 2 car washes by himself, brought in a private equity partner, and then built up the 70 car washes, sold it, and then went and did it again. So I'm like, that's the guy I want to hire, give him a huge back end return profile to come and help us build from 0 to 100. So it's not just my knowledge, but really teaming up with those high quality players and incentivizing them on the back end long term versus upfront. Like just go buy a bunch of car washes, big rewards. We get paid in the back end, and so do they, but overpay for the best top quality talent. And that's how we lead into new categories, is having that phenomenal leadership.
I have not gotten into the car wash investment space as an LP, and that's not something that we're getting into as a company. So I've only seen it done peripherally. It seems like it's become more and more of a syndication thing. What do you like about it? Like, why is this what people are doing now? Like, tell me, like, why is it a good investment? Why did you get into it to begin with?
So I think people are getting into it. It's exciting. It's new and it's different. It's not overplayed. There's massive major equity going into it. Like that's the hype side of it. Here's like the real reasons we're driving into it. So one, just the cash flow from it. These car washes are spitting off a 12% current cash flow just for the investors in our deals.
The day you buy them?
Within 90 days, yeah.
That's great. Okay.
Show me, crazy.
Ian, show me a multifamily property doing that, right?
It's never going to happen.
Show me an apartment building spinning off 12 ever. Maybe after you refi in the pro forma, but not in reality, right?
So huge cash flow. You look at, you've heard of KKR, right? Just like the mini BlackRock. They just invested $850 million last year for a minority stake in Quick Quack, which is one of the bigger growing car wash spaces. So there's a ton of consolidation upcoming over the next 5 years. So us building up a nice 0 to 100 car wash group is going to be a perfect fit in for a larger PE firm to come in and wrap up 2 or 3 people our size to build up and exit somebody else. Or for someone like Quick Quack to come in and jump onto the East Coast to roll up. So it's very much an EBITDA play. So like they're paying between 5 and 9 times the EBITDA. And you look at the larger groups. Larger groups all trade between 10 and 13 times EBITDA as a larger portfolio. And the biggest guys trade around 2021. We'll never project to exit in the 20s. We're looking to project or exit around 12, but we're only paying 5 to 8. And that's why one of the reasons we're able to pay such high cash flow, we're paying such a low multiple on EBITDA, by buying from mom and pop sellers, like we're not bidding up against like the major broker network and like we lose all those bids.
Yeah.
We grow a little bit slower, a little bit quieter, but that's why we have huge cash flow.
How do you find mom and pop? It's been like that's like the golden egg for all the real estate don't.
The phone.
Yeah.
It's not like multifamily though. Multifamily, like I own multifamily. They put my number up CoStar and I get 20 emails a day, 5 phone calls.
God.
Do you want to sell your property? Click, click, click. But in the car wash, like you have to do a little bit more digging, a little more research, but it's more like a single owner. There's not that many people trying to buy them. Like people trying to buy them, but it's not like as aggressive a space. So like they'll actually talk to you. And if you can be personable and actually build a relationship, fly out, meet them and see it. And if it's in a targeted market, it's worth it. Like you can actually do it. And a lot of the car wash owners are getting older. So we're able to give them $5-7 million in free cash after the sale. And they can still make $500,000 to $700,000 if they invest it correctly, $500,000-$700,000 a year in free cash flow themselves directly. So it's easy retirement for them. They can still live a wonderful life and walk away free, hands-free.
No seller financing. You're not doing like a package deal of like equity plus seller financing. You're just buying them out outright.
We buy them outright. We don't. I don't want to be the Pace Morby of the game where it's trying to be super creative financing. Like this is great. He does very, very well, but we want to be more institutionalized and like this is exactly how we buy, where we buy, and go for it. The more creative you get, the more complicated it gets, and sellers change their mind and just leave things like, hey, we'll buy for A. You're excited? Cool. Lock it up, get it done, and move on.
Yeah.
But
what
the
are
other
your
thing is,
what's like your heck yes and heck no for a car wash? Your acquisitions guy brings you a deal. You see one thing that's like, okay, I'm in. You see one thing that's like, nope, not doing that deal. What are those?
The biggest thing for us, and heck no, is going to be if it's already a prime car wash. If you have 5, 7, 8,000 memberships already, I can't increase value there.
Oh, I see.
All I can just try and bump retail sales. Retail sales are great, but like
they've already got the loyalty program going. They've already got, they've already done. I hear Cody Sanchez talk about when she buys businesses, she finds businesses as you're talking about, mom and pop owned. And let's call what this is. These are baby boomer owners, right? These are baby boomer owners that are aging between 65 to 85 years old that are just aging out. They want to retire. I get it. And the opportunity in the world is to help these folks do that, help them retire, right? And so you're going in and you're seeing something that perhaps doesn't have a Google pin drop, that doesn't have a cool website and rewards program, and it's not all fancy pants operations and everything like that. So if you see a highly modernized, car wash, you're out, right? Because I can't squeeze that lemon.
With one exception.
Oh.
So if you don't ask, you don't get. I'm very big on that.
Okay.
So what we do is we call up Mr. all the big nationals, like the big guys that run these phenomenal, amazing car washes. And we're like, hey, you guys have your portfolio of 780 washes. Which ones are too far out of your geographic area? Which ones are hard to manage? Do you want to dump off one or two in maybe our areas where you're not at? And we've had great success finding the larger players that want to dislocate 2 or 3. They're just like, we only have one in this state. It's too hard to manage. It doesn't make sense. Let's sell it off to you for a realistically very fair price. Because it's just one car wash. They're not that worried about it. They'll give it to us for an 8-9 times EBITDA when it's probably worth 12, 13. And it rocks out for us. It rocks out for them. Price savings, management tool. Regionals aren't having to travel. Things break down. It's too expensive for them to operate. And it fits right in our pipeline.
All right. That's interesting stuff on car washes. Best ever listeners. I hope you guys got that. Really, what I am learning here, this is always, you got to know the equation, right? Ian, like if I'm buying a thing, how am I going to create cash flow or upside for investors, either through the cash flow side or through the for sale side, correct? That's just, you've answered a lot of that right here. So then industrial comes up, right? Then we start buying industrial factories. I know you only own a few, and what got you into that space? And tell us, not many, it's not a space that many people talk about in real estate investing. Everybody talks about multifamily, as you said. So it's where all the cool kids are these days. And everybody talks about somewhat self-storage and that kind of stuff. But I rarely hear people talking industrial. And when I hear about an asset class that nobody's talking about, I get curious because that means somebody's making it work, right? Tell me more about the industrial space and what you like about it.
I think it's a phenomenal space that we're trying to grow into more. I think most people are missing out because it's not a hard space to operate. You're really looking at what are you doing? Are you buying on basis? Are you buying where you need to come do a lease-up play? Are you coming into where there's lower rents and it's double net, and you need to make it triple net. Like, what's really the play there? And once you understand that, it's very easy to associate a price and buy it and make your value add play. What we really focused on is larger industrial flex space. So like, we're not buying the Amazon giant warehouses, just big, huge triple net to them. Like,
yeah, you're not buying
Black Rocks and all
500,000 square foot steel factory and leasing it back to Bethlehem Steel or something like that, right?
No, we let those keep. But there's a huge demand for smaller businesses that want to come in, have office, have warehouse, and like decent size, not like a tiny little one. So like, we buy these 100,000, 200,000 square foot large flex spaces, and they're filled. Like, we average 96% occupancy across the board. Occasionally, like, the only downside to industrial is occasionally when you have a tenant come out, it could be a larger tenant. So you're going to take a big hit on cash flow. So like, one of our projects, we're spinning off like a 9% cash on cash. We had our biggest tenant pop out of one, and we went down to about 3.5%, 4% cash flow for about 4 months until we refilled it. So it takes a dig on your cash flow, but like, it's like what, 120,000 a month that popped out. So you got to replace that.
Yeah.
But the smaller flex space, like, it just leases back up so quickly. There's such a need for it. There's all these industrial companies, but like HVAC, plumbing, like all the blue collar companies, like, there's a huge need for it. They even have like people put CrossFit studios in them, back end catering companies, like, you name it, they're there. And it's not that expensive, and it's really easy to manage. You're primarily, half the business model is taking from double net to triple net. So you re-sign the leases, you push them. It's just like a 5-year cycle.
It's a really, really wide spectrum of people that need 4,000 square foot of warehouse plus 2,000 square foot of office to run any kind of a business, as you said, HVAC to other stuff. I got a buddy that owns a flex industrial space, and one of his tenants is a guy who sells exotic fish, right?
I love that.
And isn't that crazy? I know, right? So he's got this whole like warehouse, space full of all kinds of probably like fish that like eat, like carnivore fish and everything like that, and really, really cool fish and stuff like that. And he's brokering them and marketing them out of the office for people that are fish collectors or whatever, that are going to probably buy some exotic fish for a couple of grand off of this guy. He's breeding them and housing them in a warehouse and then providing the people that want them, How crazy is that, right? But somebody like that probably got going in their basement and then needs a bigger space. I'd love to hear the backstory. How do you get in the exotic fish business? But that's a tangent, right? So that is just an example of folks that can be a part of that spectrum. So then hotels, that's something that my company is getting into, as well as the hotel space, because I kind of view a hotel to be, it's like, if you look at it the right way, it's similar enough to be a multifamily asset. It's just that instead of by the month, you're paying by the night. How'd you get into the hotel space?
So we do the hotel space in a little bit different areas. So we focus separately than where you guys are focusing. So we focused on the conversion space, the hotel to multifamily side of it.
Oh, okay.
But only in very, very select markets. It has to be massive, massive demand for workforce housing, because they're 300 to 400 square foot units. So we came and we bought one site, bought 2 more in Jacksonville, Florida, consolidated from 1 hotel to 3 hotels into a bigger portfolio. And that went extremely smoothly. And then we also build them. So I like building them better than I like buying them. So we're just about to go full cycle on the Hyatt Andes and Turks and Caicos in January. We'll be fully built, ready to launch. And that thing is a rock star. We'll probably return in the low 40s for investors.
Great. So are you is that, yeah, but let's all go to Turks and Caicos first to enjoy it one last time before you sell, right? Are you doing a lot of international stuff, or is that your one and only international deal?
Nope. We do international hotel development. So Bahamas, Turks and Caicos, really high end. We're not going to Costa Rica. I think Costa Rica is overplayed. Very specific. It has to be top tier. So if you look at, like, say, condo sales in like Miami, like, you want to have like the Equinox building, you want to have the Dolce & Gabbana building. Like, it has to be the prime of like that, but for like beach destinations, like Grace Bay and Turks and Caicos, the best beach in the world, in my opinion. Yeah. Like the Bahamas, we're in Nassau, right by Paradise Island, or like the Atlantis. Like, that's what we're developing. So it's key, phenomenal places with massive demand, and places we also can sell this hotel development to another larger group, to either BlackRock, Chinese money coming in, which is a lot of the international hotel development is being taken over by the bigger Chinese corporations.
And are these branded? Are these like, Hilton, Marriott, IHG assets, or are they independently branded?
So the one Turks and Caicos is the Hyatt Andes. They applied there. They also contributed $5 million in LP equity to the deal, which was really interesting.
Wow.
Mm-hmm.
Okay.
So
Getting into the equity world, right? You've told me originally it was a lot of your money, and but you were able to transition over to private equity. And a lot of people that are listening, that me included, have flirted, danced around, poked private equity with a stick, that kind of thing, thought about it. But you've decided that that's how you were going to scale, and perhaps that's how you've been able to get into a lot of the larger projects that you've done is through OPM, but with much larger checks. Why did you make that transition, and what's it been like?
So we started off with institutional equity, and it is the greatest and the worst thing imaginable. And I'm dead serious. If you're a syndicator listening to this and you do great with retail investors, love it, enjoy every moment of it. That large $16 or $24 million check that we raised from institutions, it comes with a lot of tags to it. So I'll give you a couple of fun stories. So we were buying a deal called the Perry in Houston, Texas, $40 million assets. I think it's like $12 million check. And we met a local Houston private equity group. They went to the full stack. They did $4 million. I was like, okay, like we can work with this. I went and found another group for another $4 million, another institutional group. It was Citizens Bank. I can say that one. And then we came in with the other four on our side. And I told the original group, it's like at $4 million out of 12, you're not going to have control rights. You'll have partial, like your voting share, but you're not having the overall control rights in any ways. And like, cool, we understand. We'll work with the other private equity group, and you, like, everyone will have, cool. 7 days before we're set to close, I think it was like 5. They said, hey, we're going to need full control rights to write all this money in. And I'm like, we already have the offer agreement signed off on. I'm closing, and I got $2 million in hard money down in this thing. Like, what are you talking about? Yeah, we're out. Like, we're out. And I'm like, so I'm really sitting in my garage, like almost in tears, because like this is back in like the prime when like my money was hard. The other group's going to take it and then just resell it to somebody else. So I'm out big cash. So the other equity group came in with another $1.5 million, and then we came in and raised, I think it was $3 million or 2.5 in 7 days. And like, I dropped everything. Our whole company dropped everything we're doing and just raised it. Like,
you probably got 7 hours of sleep in 7 days that week, right? Yeah.
The problem is, like, it's a big risk. Like, do they actually show up with that equity? Like, we've gone full cycle with Related Group, Electra, and a bunch of other people, and like, no matter what, they show with the money. But you have to be careful if your first time working with somebody, if they don't show, they don't show, which is wild.
Yeah. And that's a risk factor that you have. And that's likely the story that I've heard from a lot of syndicator friends of mine, that they either have that fear or they have that story that you do. Their private equity firm is like, yep, I'm in, let's do it. 10 million, that's what we're going to put into the deal. And then they decide that they're going to, is there a way to protect yourself against that? Like, can you hold them accountable to the money, or can they literally just like, nah, we decided to go to something else, we're good?
They'll never sign anything. I feel like a $50,000 or $100,000 fee you can get out of it, but they're not putting themselves at risk for anything ever. That's the risk profile. That's why people like to tend to go to family offices, because it's so much more relationship based, and they care about that relationship, and their name is so much more than the big P shops don't care. Here's a dime a dozen to them, your employee. The family office world is so much more relationship driven. Like, family office will wire you the money before closing. They don't necessarily have to wait to title. Institutions wire title at closing. You get your money from family office early. And I love that space. Like, we're a family office, so it's much easier for us to connect and talk with them. And if you get a family office to invest once, like, they'll invest in every single deal you have going forward as long as you perform. So it's a huge space.
How does someone who's raised, like, give me the avatar for a syndicator, that's maybe a best ever listener here, that's achieved a certain level. They want to get to the next level. They probably want to keep syndicating and keep working with retail investors, but they want to start attracting, maybe the pivot point is, I want to start attracting some bigger checks by getting into the family office world, right? Give me the avatar. Like, what story do they need to be able to tell to get in front of their first family office, to get to be taken seriously?
It's not necessarily the story. It's the hardest part is getting in front of them. Like, that's the hardest part ever. And then comes your story. So, like, for us to get our first family offices, we went and we did a roadshow for 2 weeks. We started in Miami and went all the way up to Jacksonville, Florida. We literally went to over 75 different family office locations, went in, hey, it's who we are, what we do. We'd love to work with you guys. It's our portfolio,
Wow.
our background, like just hardcore like pitch. Like they're happy to meet with you, but like most people aren't willing to go take 2 weeks and do a roadshow.
Mm-hmm.
You have to do what it
How'd you
takes.
find them? Is there
You
like,
can just Google it. Like
familyofficelist.com, that kind of thing? I mean, I've heard like there's family office club and that kind of stuff, but I don't know if that's really where all the family offices go or not. It's mostly syndicators, right? Is that
it's
why?
85% sponsors, and most family offices.
I don't think that if I'm a family office, if I'm running around with like, God bless me, $200-300 million of family accrued money, I'm probably not going to go to a conference and talk to Knucklehead Johnny in a booth that's got, a couple hundred units of multifamily that wants me to invest with him, right? That's likely not what I'm going to do, right? Maybe there's deeper networks and whatnot. So what is a better way? How do you obtain that list so you can go and roll your sleeves up, get all your nice clothes out and go do the dog and pony show, as you said? How do people find that list of family offices to start cold calling? Because that's what you did. You're talking about doing cold calling, doing the hard work of getting in front of these family offices, right?
If you want a list, I'll email you one. It's easy.
All right.
They're
Okay.
not that hard to find. I'm not giving away like indentured secrets. Like they're pretty public. If you want to do the work and consolidate them, like you can scrape it up pretty quickly. Because most of them are like, you can go find Bill Gates' family office, the information for who they are in about 2 seconds online. Like it's
when you're
difficult.
reaching out to a family office, are you just, is there when they're sophisticated enough on the website or whatever, is there someone that you go to that's like, hey, this is the person that if you got a deal that this family office might be interested in, call Johnny Boombots, this person right here? Or do you have to infiltrate further than that?
Most of them have a website, and everybody loves to show their team off, right? Like this is our team, this is who we are, what we do. And then you can go also on LinkedIn, like you can find the name of that company, then go to LinkedIn, you can see every person that works there, connect with one or two. Like you're not going to like the chief investment officer, because like that guy's up here, he's not talking to you, he has no idea who you are. Mm-hmm. Start with like the associate, start with like the head underwriting guy, like, hey, can I shoot you over like our latest deal? Get your feedback on it as if it might be a fit for your guys' profile. Like you need to submit you everything, but like just get yourself in. The biggest trick is don't be afraid to give a family office a really good deal for the first time. Like, don't give them like no fees, no promote. Like that's too good to be true for a family office. But like give them a 90-10 split with a 10 prof. You're not going to make much money on it. Lower your fees to 1 and 1, which you don't want to do, but do it. Mm-hmm. Because once you get one of them to invest, the biggest thing we love to do is co-invest. There's by far one of the best people, his name's Shane, in Miami, another family office. And he's the best tech guy I know. And every time he's like, hey, we're going to go do this tech investment, I'm in for $100,000 without looking every single time, no matter what it is. So if they like you, they tell all their other family office friends about it. And they like control. So instead of me putting $1 million in, which is like our average investment size from a family office, I'll call 5 people up and we'll take down the entire stack. We get a little bit of control rights, we get a better deal, but we just did the whole deal from 5 different family offices pulling together.
You said 90-10 split. Typically, syndicators are selling to retail investors are used to 70-30, 80-20. Drop your acquisition fee to 1%, drop your asset management fee to 1%. So get a little more skinny, understanding that a family office is going to be able to open up the doors to you. Do you recommend a syndicator like myself or like anybody else listening here? Should they like create another share class for a family office to sit? So like the family office gets these Class A shares, and then the retail investors get B class shares. Are they okay getting blended with retail investors too? Is that typically a family office acceptance?
It's not really a conversation in the beginning. So that's not part of your sales process is how you're structured. Yep. They're going to structure it how they want to structure it. So they're going to take a look at your PPM and say, cool, we want to come in like this. They'll either create a share class, they'll do their own JV with you, and you can have everybody else come in on your own side. It's really how they want to structure it at the end of the day.
They're going to tell you how it's going to go. It makes sense. If they're writing that big of a check, they are going to tell you how it's going to go.
I'd worry less about trying to talk to them about structure. It's because that once they're in, then you're going to worry about structure. So structure's not coming until they're in.
I see. Yeah. So really you got to get their interest in you and the asset class, like sell yourself, sell the asset, sell the deal, and then they will help you structure it.
They're already involved. Right. They're already in. Cool. Like, hey, we're excited. We're going to do this. Here's like, you present them your structure, your org chart. They're say, cool, we want to make these pivots, but they're already in and dedicated that time. So they're fully functioning. You're working with somebody in their team and it'll get knocked out.
Got it. Is a family office typically going to require a co-invest, meaning like, the sponsor themselves writing a check personally, or like go get 10, 15, 20% out of your network or whatever? Like, are they going to let you syndicate it? Like if they say, okay, I need to see 15% from you. Got it. Are they going to make you go and pass a hat around to your network? Are they going to allow you to do that? Or are they going to require it to come from you personally to go into the deal?
Let's have an honest conversation about it, right? So family offices love the co-investment, but they look at like who you are. How much can you actually afford to invest? But like, let's look at the real back end. Do they really know where your money comes from? Not necessarily. As long as it's coming from your entity, you can syndicate most of it on the back end. Unless like you're putting in your contract, I personally am doing this. Like that is one of the biggest loopholes when investing with institutional equity family offices. Unless they say it has to come from you versus your entity, you can take whoever you want to into your entity as an investor.
Yeah.
So like that's the behind the scenes thing. If you want to talk about it for people, family offices love. So like if you can put in 200 grand, 500 grand, roll it in, like they love that. They love seeing more money than your act fee. People love seeing that. I know syndicators always love to put as little in as much out as you can, but the more dedicated you are, that's one of the reasons we've done very, very well. Is at a minimum, we invest, say the last car wash deal we did, it's a $15 million fund. We're putting in $2 million directly into that fund. So more than 10%. I mean, got the huge cash flow, so I want it. But people love seeing that. Like, okay, cool. Like you truly are invested. And like, if this thing's not going well, you're going to jump your ass in there and fix it because you got big skin in the game.
Let me just throw out there for the best ever listeners to understand. It is common in our world for somebody to want to co-invest, to want to say, okay, well, great, I'm going to put in a big check. I want to see money come from you too. And it's common for a syndicator to say, okay, I'll just roll my fee in. And so my fee is supposed to be $400,000. I will then take 100 grand, 200 grand of that fee and put it in my own pocket, and I'll roll the other 200 in. And then there's my co-invest, magic fairy dust. I'll take 200,000 from the deal and put it back in as an LP investment. That's good. But you're saying that the family office is going to see through that, and they're going to want to see more than what your fee is going into the deal. So you're not just taking the fee out of one hand and putting it into the other and then back into the deal, correct?
Most larger groups do not want to see you roll your fee because they expect you to use that fee to rent personnel. Like they took that fee to go pay for your company growth and things like that. And then the asset management fee carries you through the rest of the years. They want to see you actually have skin in the game, something to risk. Yeah. So your fee is earned, which is great. They want to see it like real cash at risk.
Yeah, it's interesting, Ian, though, in our world, and maybe this is because of like the real estate educators that are out there or whatever, most syndicators are in this game for that fee. Like all they're going to do is put that fee in their pocket and live off of it. They're not going to build a business off of it, which you really ought to do. That's what it's designed for, right? It's designed for you to take that and invest it back into your company, maybe make a hire, maybe like you said, invest in infrastructure so that you're just that much further along as a company. But because of a lot of the, syndication splash that's happened over the last 5 years, 10 years in the US, a lot of people are doing the deals and just taking that fee, and it's going right in what they call the hip national bank, just right in their pocket, and they're just living on it, and maybe buying themselves a Ferrari so they can take a selfie in front of it, all joking aside. But that's never what that fee was designed for, I don't think.
One last chime on that. After you've done 4 or 5 deals, they really stop caring about how much cash you have in because you've built that trust and economic structure with them. So it's so much less about how much money you have in. Like they'll almost do 95.5 or 97.5, 2.5. Because they want to put more money in to work with you. So they'll take much more of the stack. They're so much less concerned with your money in. They'll beat you a little bit more on the fees if you have no cash in, which is a fair trade. But like you literally can almost go to a deal with only bringing 2.5% of the equity stack, which is super nice.
So to unpack it all and working with, perhaps institutional, sounds like family offices are way more friendly to deal with. And say, but you know what? I was going to say, I was actually going to unpack this whole conversation, but I actually just came up with another question. Why would one ever go with a institutional firm versus a family office? It sounds like you've done both. Is there a reason and a benefit sometimes in going to an institutional funder?
They can write larger checks repeatedly. So
Mm.
family offices are built differently. Some family offices are 100 million and they write $2 million checks. Other family offices are $1 billion family offices and they write $25 million checks. So
Ah,
you
I
may
see.
only have family offices that can write certain check sizes, like 5 million, maybe their max per investment. And your self-storage multi-family deal is a 17, 15, $21 million check size. These institutional groups can knock it out in 5 seconds. And if you get in with them continuously, they'll do it every single time. So like you look at Related, we've gone full cycle several times. You look at Yield Street, we've gone full cycle several times. And they're literally asking you, hey, when is your next deal? We got hundreds of $1 million ready to place with you, and we're excited to do it again. So it's that bigger check size, and it takes out the entire thing. Like that's why people go there, and we continue to have it. It puts the lights on. Like you don't make big money on it, but like it covers your costs, covers your rent, covers your insurance. You make money elsewhere. But we'll continue to use institutional money.
Yeah. So you're saying but let's pause there, right? You said that you don't make money. I get you make money, right? And it's not a hobby, but you're making enough, but not life-changing, business-changing money when you work with these guys because of how much they limit your fees and how much you guys are able to make. But you're still able to grow, scale, feed the machine, so to speak.
You make 3x on a retail investor than you do an institutional.
Write that down, best ever listeners. 3x is this indicator, but velocity, right? Maybe I can do more than 3x deals, in working with a larger institution like a family office or an institutional investor.
Look at it this way too, from a management perspective. Like here, we love retail investors, but say you have $250,000 investors, the time and the cost to manage those investors versus one institutional group that's in actually 5 questions once a month versus 220 K1s, 80 email requests on my K1's going to be here on time. My distribution should have been 5%, it's 4.5%. Like you don't have any of those questions. So it's much lower in staffing. You have one asset manager that can manage 11 deals. That's a lot more, like 7 or 8 institutional deals and manage that flow versus you have to have a huge investor relations staff and you have that many retail customers just to have all the touch points. So very different, but they pay well and both work. Money's money. Take it
and
in.
help you scale. Right. So you've achieved this point of success, right? What's next for Blake Capital Group? Where are you growing into? Give me like a big, hairy, audacious goal you got. You're already, 2.2 billion, right? Where are you at next?
We're sitting back and actually asking our investors what they want to invest in. And do we have what they want? And that's what most people don't do. Most people are like, they take Rice 48. They're a massive multifamily player and like they're never going to do anything but multifamily for the next 50 years. And that's not what we want to do. That's not what our investors want us to do. Our investors want to try and invest with 1 or 2 groups that can do a variety of different asset classes. So it's like, hey, what do you guys like? Like for the car washes, we get asked to do car washes for a year before we did it. People were loving them, wanting to invest in them. And it took us a year to go research. We invested in 3 different car wash companies ourselves before we did car wash ourselves to learn. And then we brought in the biggest operating partner. So it's how can we focus, bring in the best, the brightest staff to come in and offer phenomenal returns that investors want. It's also going to change in cycles, right? Some of our investors only focus for appreciation. So they love our self-storage deals because they're in the mid to high 20s IRRs, but there's no cash flow for 3 years. Versus our cash flow guys are like, no cash flow day one, get out. They're jumping into the car wash. Like, give me my 12%. I'm happy. I want it. Let's go. But it's really listening to our retail and institutional investors and like, this is our target metrics. And it changes in the economic cycles and the real estate cycles and what they're looking for. And it's how do we actually provide what you want? It's not necessarily about us, how we want to grow, where we want to grow. It's how we be of service and provide what our investors want and still make money in doing so.
And go get it.
And like, we're not going to do 20 different asset classes. So you're like, we're not going to be crazy, but it's, do we focus more and build our ramp and self-storage pipeline? Do we build more on car wash pipeline? And we do it every quarter. We put it out and like, hey, we're looking at A, B, and C, D. Like, what do you focus on? What are your returns? Are you focusing on cash and cash? And if you are, what percentage current yield makes you happy? If we're offering a pref, do you like this? Like, is a 12% too crazy? Do you believe in a 12% preferred return? The feedback we got was no, that's too high. We don't think it's realistic. Give us what we're used to and normal to and keep it at 8. So we thought about doing a higher pref for some of our development deals. So people felt set for saying like, hey, before you guys make money, we know we're going to make a 12 or 15% preferred return. But they're like, it's just too unrealistic. No one does that. So we just scaled it back to the 8 and left it there. So it's really just listening and giving people what they want versus forcing investments out there.
That's a great best ever listeners. I think that, you want to raise money. How about you ask your investors, whether you're retail or not? I think that principle applies to a retail sponsor or those that are either desiring to or already working with more sophisticated organizations. Ask them what they want and then go get it. And you can partner with them, and make money alongside them in helping them meet their investment goals. Before I let you go, you have an interesting product because you do also work with retail investors through a fund you have called the Get to Know Us Fund. Can you talk to me real quick about that and how that works and why you decided to start it?
So we had a huge background in institutional, and we really wanted to get into retail, and we wanted to make a strong standpoint with it. And I've always been a believer of giving people what they want and give someone zero reasons to say no. Like if you can't find a reason to say no, like I have to do this. Like, why would I not do this? Like, let's ask that question. So we sat down and said, what's a way that we can get retail investors into a new deal? They come try us out, and we created the Get to Know Us Fund. It's a multifamily thing because everyone's comfortable with multifamily. They understand it. It's only 2017 and newer Class A assets, all beautiful and brand new. Minimum investment's down to 50 from 100K. And there's no fees of any kind. There's no asset management fees. There's no acquisition fees. There's no fees at all. Everything stays in the deal, so we don't dilute it in the beginning. And the biggest thing is I have a very large network. I'll personally guarantee any retail investors first $50,000 investment with us. Just once, one time only, 50K. And that's something that most other groups, syndicators are unwilling to do. And we're willing to make that on a first-time gestures. Hey, you know what? Come in, try us out. If this deal blows up and we don't perform, I'll just give you your money back. Like your money's safe. So it's a $5 million fund. It's something I could easily afford to repay back if it went bad. It's Class A multifamily. It's not going bad. It's just going to cash flow from day one and just cha-la-la along. But it's that way they come in, see cash flow day one, see reporting day one. It's like, how do you try somebody out risk-free and get to know them instantaneously with the goal of hopefully you come back next year and invest $100,000 in a real deal with us. And like, we'll make some money then and build a long-term relationship. Yeah. So nothing crazy or exciting, just willing to do something that nobody else is to have you come try us out.
It's kind of a mic drop there. I mean, at the end of the day, I mean, it's one of those things where it's kind of hard to beat for a personal guarantee on your equity investment. So, and not everybody's able to do that, but you're able to, given the net worth you have and all that. So why not put that there to backstop the investment, So I think it's really inspiring. For those that want to hear more about the Get to Know Us Fund or about you or about your company or any of those kinds of things, how do folks reach out to you to hear more?
Best way is always email Ian@BlakeCapitalGroup.com or Rob@BlakeCapital.com. He's our Director of Investor Relations. We're always here and available. You can follow us on socials, Blake Capital Group at Facebook, Instagram, YouTube, everywhere, anywhere. We're pretty active in posting our behind the scenes of what we're doing, from whether it's hotels, multifamily, self-storage, where it's always photos and videos. So come follow along on the journey. If you don't want to invest, just come watch and enjoy.
Great. Well, Ian, it's been great having you today on the Best Ever CRE show. I'd love to talk to you again soon. Thank you so much for all your insights today.
Thank you so much for having me. Thank you, Best Ever listeners, for having me as well. I appreciate it, guys.
Guys, great interview with Ian Djuric. I really like what Blake Capital Group is up to. Really inspiring. In what I liked was him talking about the diversification of asset classes and asking his investors what they want to get into. Why would you try and force a square peg into a round hole? Why not ask your investors, whether you're working with retail investors or, as he is, large corporations that are investing with him, whichever one you're doing, why not ask your investor base what they want to see and then go find that, because then you'll make money because with them investing with you in that asset class. Pretty simple. So I want you guys to consider that and also consider coming to see me next Friday when my episodes for Best Ever CRE come out. Every Friday, make sure you subscribe to this show and make sure you share it with a friend, as I said before. We'll talk to you guys soon and have yourself a best ever day.